Ever think about what happens when a bond, gets downgraded? Like what happens?
Oh, interesting question.
Like a lot of investors are suddenly told, "Hey, you got to sell these things no matter the price."
Right.
It's called a fire sale. And well, it can really kind of send these shockwaves through the market. And it even can impact your investments.
Yeah, absolutely. And it's more common than you might think. But what's really interesting is that um, these insurance companies,
Okay.
these giants, right, of the financial world, they play a huge role in this whole fire sale risk.
Insurance companies.
Yeah.
Really? I wouldn't have guessed that.
Oh, yeah, absolutely. Today we're diving into some excerpts from the Journal of Financial and Quantitative Analysis,
Sure.
specifically a 2019 study called Investment Commonality Across Insurance Companies, Fire Sale Risk and Corporate Yield Spreads.
Hmm.
And it really shines a light on how insurance companies' investment habits can actually create these fire sale situations.
Okay, so let's unpack this a little bit. First off, how big are we talking here? Just how much do insurance companies invest in corporate bonds?
So from 2002 to 2011, insurance companies held, get this, over 3/4 of all outstanding corporate bonds in the U.S.
Wow.
Yeah.
That's a lot. I mean, that's way more than I would thought.
That's a massive chunk of the market.
So what's the problem with that?
Well, the study highlights that insurance companies often invest in very similar bonds.
Okay.
So they're all kind of drawn to the same types of investments,
Yeah.
looking for those long-term, relatively safe bets that can generate steady returns.
Okay, so I get that insurance companies are huge players in this bond market and that they often have similar investment strategies, but where does the fire sale risk come in?
It comes down to regulations and the way insurance companies have to manage their capital reserves.
Okay.
So they have to maintain certain levels of reserves based on, the riskiness of their investments. Now, if a bond gets downgraded, its risk profile increases. And insurance companies all of a sudden need more capital to back it up.
So they have to sell some of their holdings to free up cash?
Exactly. And since so many of them own the same bonds, they all end up trying to sell at the same time when that downgrade happens.
Oh, so that's the fire sale?
Exactly.
Everyone rushing for the exits at once?
Exactly. And that rush to sell, well, it drives prices down, right?
Right.
And it creates this chain reaction that can impact the whole market. It's like a domino effect.
Ouch.
Doesn't sound good at all. So how does this affect, like someone like me? Like, who's thinking about investing in bonds?
Well, here's where it gets really interesting. The study found that bonds that were heavily owned by insurance companies, they actually had higher yield spreads. So think of it like this. A yield spread is basically the difference in return that you get compared to a super safe investment, like a U.S. Treasury bond.
Uh-huh.
Okay,
So a higher yield spread means more risk.
exactly.
Right.
The market recognizes that these bonds are more susceptible to fire sales.
Right. So investors demand a higher return to compensate for that risk.
Interesting. So it's not just about the bonds rating, but also who owns it. Like, if it's popular with these insurance companies, that's a red flag.
It's definitely something to consider, especially if you're looking at bonds that are, closer to that line between investment grade and what they call speculative grade,
Oh,
or what some people call junk bonds.
okay. And why are those bonds particularly risky?
Well, because a downgrade from, say, BBB to BB, that could push the bond into that junk territory.
Right.
And that would trigger mandatory selling by, certain investors who just aren't allowed to hold non-investment grade debt.
Oh, so that just adds fuel to the fire sale.
Exactly.
Got it.
And the study also found that this effect was even stronger when the bonds were held by insurance companies that didn't have a lot of flexibility with their capital.
So it's not just how many insurance companies own the bond, but also the types of insurance companies involved.
Precisely.
Okay.
Those companies with less capital flexibility are the ones who are much more likely to be forced sellers, if a bond gets downgraded.
Right.
And that, in turn, makes those bonds even riskier.
Wow. Okay. So this is way more nuanced than I realized. I mean, there's a whole hidden layer of risk here that I think most people probably aren't even aware of.
That's why this research is so valuable.
Yeah.
It unveils these hidden connections and dynamics that can have such a significant impact on the market.
So I'm guessing this whole fire sale risk was especially bad during the 2008 financial crisis.
You guessed it.
Yeah.
The crisis just amplified everything.
Right.
downgrades were much more frequent, and insurance companies were facing, their own financial strains,
Right.
which just added fuel to the fire.
So this isn't just some theoretical risk, it's got real-world consequences.
Absolutely. And that's why, we're diving deep into this today.
Hmm.
Want to help you understand these dynamics so you can make more informed investment decisions.
This is fascinating stuff. I'm sure our listeners are eager to learn more about what this all means for them. Okay, so we've talked a lot about the risks, of all these insurance companies' investment habits and everything, but are there any potential upsides here? Like, could this concentration of bond ownership actually be a good thing in some ways?
Yeah, that's a great question. Some would argue that this concentration can actually help stabilize the market.
Oh, interesting.
Yeah. After all, insurance companies are kind of known for taking that long-term approach to investing.
Right.
They're not usually looking to, just make a quick buck. And they're also subject to, a lot of that regulatory oversight.
So they're not as likely to, panic and make rash decisions if the market takes a little dip.
Exactly. So, in theory, they could act as a steadying force, right?
Yeah.
Hoping to smooth out some of the volatility that we see in the market. However, there are a couple of big ifs here.
Okay, I'm intrigued. What are those ifs?
So the first if is that the insurance industry itself, needs to remain financially healthy.
Right.
If insurance companies start facing, big losses, either from bad investments or a surge in claims, all bets are off.
Right.
They might actually become, a source of instability in that scenario.
Yeah, that makes sense. I mean, they can't exactly be a calming presence if they're caught in the middle of the storm themselves. So what's the second if?
The second if is that the regulatory landscape needs to stay relatively consistent and predictable.
Okay.
If regulators suddenly change the rules of the game, let's say by requiring insurance companies to hold even more capital or, restricting the types of investments that they can make, that could throw a wrench in the whole system.
So it's like this balancing act, right? Where
Right.
insurance companies can be this source of stability, but only if the conditions are right.
Exactly. And that, really underscores the importance of having, strong, sensible regulation, both at the national and international levels. Regulators need to keep a close eye on the insurance industry, making sure they're properly capitalized to handle potential shocks.
And they also need to be really careful about, making these sudden changes that could end up doing more harm than good.
Exactly.
Yeah.
It's a very complex ecosystem, and this whole fire sale risk is just one piece of the puzzle, but it's a crucial piece because it shows how something that might seem like a niche issue,
Right.
the investment behavior of insurance companies, can actually have these wide-reaching consequences for the entire market.
It really highlights how interconnected everything is in this financial world. Speaking of interconnections, the study also delved into, some specific factors that can kind of amplify this whole fire sale risk. And one that stood out to me was this whole idea of a bond's rating and its proximity to that investment grade, speculative grade boundary.
Right, yeah. We touched on that a little bit earlier, but it's definitely worth exploring further. This boundary is like a critical dividing line in the bond market.
Right.
On one side, you have like your investment grade bonds, which are considered relatively safe.
Right.
And then on the other side, you have what they call your speculative grade or junk bonds, which carry more risk.
Right. And a downgrade from, investment grade to junk can be a big deal, right?
Huge. Absolutely.
Yeah.
It can trigger a whole wave of selling. A lot of these institutional investors, like let's say pension funds or mutual funds, they have very strict rules about how much non-investment grade debt they can hold.
So downgrade could force them to sell even if they still think that, the bond is still a decent investment.
Exactly.
Yeah.
And if you have a lot of these big players forced to sell at the same time, well, you can see how that can very quickly turn into, that fire sale situation and drive prices down even further.
It's like a game of musical chairs. The music suddenly stops. That's the downgrade. And then everyone scrambles for a seat, but there aren't enough to go around.
That's a great analogy. And that's why this boundary between, investment grade and speculative grade is so important. It's not just about the absolute rating of the bond, but also where that rating sits relative to this really critical line.
So a bond that's rated BBB might seem okay on the surface, but if it gets downgraded, watch out.
Exactly. And that brings us back to the importance of looking beyond just the surface.
Right.
It's not just about the rating of the bond or even how much it's owned by insurance companies. It's about which insurance companies are actually doing the owning.
Right. We talked about that earlier. The ones with less capital flexibility, those are the real wild cards.
Exactly. They're the ones who are much more susceptible to being kind of, squeezed by a downgrade and forced to sell.
So if I'm considering, investing in a bond, I shouldn't just check the overall ownership by insurance companies. I should also try to dig a little bit deeper and see, what kind of shape those companies are in, financially speaking.
That's exactly the kind of critical thinking we're trying to encourage here.
Hmm.
Don't just rely on the surface level data. Dig deeper. Understand, the motivations and potential limitations of the players involved.
It's like being a financial detective.
I love that.
Yeah.
And this whole investigation into fire sale risk reveals that there's often a lot more to a bond price than meets the eye.
It's like one of those optical illusions. You think you see one thing, but then you shift your perspective a little bit, and then a whole new image pops out.
I love that. That's a great way to put it. Fire sale risk is kind of like that hidden image.
Right.
Once you see it, you just can't unsee it.
Right.
And it can just fundamentally change how you approach, bond investing.
So we've established, that fire sale risk is a real thing. It's priced into the market, and it can be, especially pronounced in certain situations. The big question is, what can be done about it?
That's the million-dollar question. And it's one that, policymakers and regulators are really wrestling with.
Yeah.
There's no silver bullet here, but there are a few approaches being discussed.
Okay, I'm all ears. What are some of those approaches?
Well, one idea is to try to, reduce that commonality of investments among insurance companies.
Okay.
So, encourage them to diversify their portfolios more, perhaps through like regulatory incentives or by developing, new investment products that cater to their specific needs, but, don't all end up in the same basket.
So instead of everyone crowding into the same, quote unquote, safe investments, there's a wider range of options out there.
Exactly.
Okay, that makes sense. What else?
Another approach is to really focus on bolstering the capital reserves of insurance companies. So the thinking here is that, if they have a bigger cushion to absorb losses, they'll be less likely to be forced into those fire sales in the first place.
Right. It's like having a bigger emergency fund, right? You're better prepared for those, unexpected expenses, and you're less likely to have to resort to those drastic measures.
Exactly.
Are there downsides to that?
Well, yeah. Requiring insurance companies to hold more capital, could make insurance more expensive or reduce the returns that they can generate for their policyholders. So it's kind of a trade-off.
Always is with these complex issues. But it seems like, the key is to try to find ways to make the insurance industry more resilient, right? So they can, weather those storms without creating a tsunami in the bond market.
Well said. And that brings us to, another really important aspect of addressing this whole fire sale risk thing. International coordination. As we discussed earlier, this is a global issue.
Right.
If one country tightens regulations, it could simply push the risk elsewhere.
It's like squeezing one part of a balloon, all the pressure just shifts to another part.
Exactly. So there needs to be this concerted effort among regulators around the world to establish some common standards, and make sure that the insurance industry is adequately capitalized globally.
Yeah, it's a tall order, but, essential if we want to avoid repeating the mistakes of the past. Because as we've seen, what might seem like a localized fire sale can quickly spread and become this global conflagration.
Yeah. And speaking of global conflagrations, the study also examined, the impact of the 2008 financial crisis on this whole fire sale dynamic.
Okay.
And not surprisingly, things got a lot worse during that period.
Yeah, I can't imagine anything getting better during that time. But it's interesting to hear how, this specific risk played out.
Absolutely. Downgrades became more common. Insurance companies were under, just immense financial stress. And investors were demanding even higher premiums to compensate for that increased fire sale risk.
So it was this, vicious cycle, right? A crisis hits, and then, the risk of these fire sales goes up, which makes investors even more nervous. And that just feeds back into the crisis.
Exactly. And that, that really underscores the importance of having these, robust safeguards in place to try to prevent those feedback loops from just spiraling out of control. So we've covered a lot of ground today, and, it's clear that fire sale risk is a complex issue with, no easy answers. But I feel like we've gained some valuable insights into, how it works, why it matters, and what we should be asking ourselves as investors.
I agree. And I think, one of the biggest takeaways here is this. Don't just focus on, those obvious risks.
Right.
Think about those hidden connections, the potential for those cascading effects, and, the motivations and limitations of all the different players involved.
It's about seeing the whole board, not just the pieces right in front of you.
Exactly. And that kind of big picture thinking, that can really make all the difference in navigating the complexities of the financial world. Yeah, it really is a great reminder that there's always, more to the story than meets the eye.
Right.
This study focused on those traditional corporate bonds, but it kind of makes me wonder if this whole fire sale risk thing could apply to, other types of assets too.
That's a really insightful question.
Yeah.
And the answer is quite possibly yes.
Oh, okay.
The same underlying mechanisms
Right.
that concentrated ownership, the regulatory pressures, the, forced selling,
Right.
that could definitely play out in other markets.
Like what? Give me an example.
Well, take real estate, for instance.
Oh, okay.
Certain types of commercial real estate, like, let's say, office buildings or even shopping malls.
Right.
Those are often held by, big institutional investors like pension funds or insurance companies.
Right, of course. So if those properties were to suddenly lose value, let's say because of, a recession or some change in consumer behavior, it could trigger a wave of selling by those investors, right?
Yeah. Exactly. And if those investors are facing, their own financial pressures, they might be even more inclined to sell quickly.
Yeah.
Regardless of the price.
And real estate isn't exactly known for being, the easiest thing to sell quickly. It's not like you can just click a button and unload a skyscraper.
That's right. Real estate's much less liquid than stocks or bonds.
Right.
So those fire sales, those could be even more dramatic. I mean, prices could just plummet, and it could take, years for that market to recover.
Wow. So it's not just about, the asset class itself. It's also about, how easy it is to buy and sell those assets and also what types of investors hold them.
You got it. Another area where this dynamic could play out is in the world of private equity.
Oh, okay.
So private equity firms, they often use a lot of leverage, borrowed money, to buy companies.
Right.
And if those investments go south and they start getting squeezed by their lenders, they might be forced to sell some of their holdings, potentially at, fire sale prices.
And since, those private equity investments aren't publicly traded, it's not like they can just, list them on an exchange and find a buyer instantly. That can be a much more difficult and time-consuming process.
Exactly. And that lack of liquidity can really, really exacerbate a fire sale. I mean, prices can spiral downward as sellers get desperate to unload their holdings.
So the ripples from a fire sale in, private equity could spread throughout the entire financial system. I mean, banks that lent money to those firms could take a hit, and investors in those funds, often pension funds or university endowments, could see their returns, evaporate.
Exactly. It all comes back to that interconnectedness we were talking about earlier.
Right.
These different parts of the financial system might seem separate, but they're all linked, in ways that we might not always appreciate.
It really is like a giant web. You tug on one strand, and it can send vibrations throughout the entire structure.
That's a great way to think about it. And this research on fire sale risk really does give us a new lens through which to view those connections and, try to anticipate those potential risks.
So as we kind of wrap up this deep dive into fire sale risk, what's the key takeaway here for our listeners? What do you want them to remember?
I think the most important message is this. Don't just focus on the obvious risks,
Right.
Think about those hidden connections, think about the potential for those cascading effects, and think about, the motivations and limitations of all the different players that are involved.
It's about seeing the whole board, not just, the pieces that are right in front of you.
Well said. And that kind of holistic big picture thinking, that can really make all the difference when you're navigating, the complexities of the financial world.
That's a great note to end on. Thanks for taking us on this deep dive. I feel like I've learned a lot, and I'm sure our listeners have too.
It's been my pleasure. I always enjoy, exploring these fascinating dynamics with you.
And to our listeners, thanks for joining us on this journey. We hope you found it insightful. And as always, we encourage you to, keep learning, keep exploring, and keep asking those tough questions.
Because the more we understand about how the financial system works, the better equipped we'll be to make, smart decisions and ultimately achieve our financial goals.
Until next time, happy investing.